You're locked in to the hottest station on the planet.
Resistance is futile. The revolution has begun.
You're listening to Rebelpreneur Radio, helping you break the rules and build the business you need for the life you want. And now, broadcasting his pirate signal
from somewhere beyond the status quo,
here's your host, best-selling author, marketing and media strategist, Ralph Brogden.
Hello and welcome to Rebelpreneur Radio. It's the show that helps you build the business you need so you can live the life you want. I'm Ralph Brogden. Well, do you need money to start or scale a business? If so, then you'll be really interested in what today's guest has to say. He's going to share with us the venture capital outlook for 2020. I'm here with Kyle Asman. He is the founder and investor who has launched his own venture fund, and I can't wait to find out more about how all of that works. That's a mystery to me. So welcome, Kyle, to Rebelpreneur Radio.
Yeah, Ralph, thank you so much for having me on.
Tell us a little bit about your background and how did you get started in the venture capital world?
Sure, yeah. So I was always interested in equities from an early age. Public stocks. I was always fascinated by the quick movements of price and all the opportunity it presented. So then, kind of looking at venture capital as a way to really maximize your profits, right? So you're looking at different sorts of investment opportunities, and the returns that can generate are far more than public equities. The time horizon obviously can be a tad longer, but it's just a super interesting marketplace to me to get in a company at the ground stage and be able to invest with them and advise them on how to build a business.
So really break it down for us, because I think there's a lot of misconceptions about what venture capital is and how it's used and who qualifies for it. Tell us a little bit more about what a venture fund is.
Sure. So a venture fund focused on investing in companies that currently aren't public. So that means they're private. They could be early stage. It could be one person. It could be 100 people, 1,000 people. So it's a company that's not available on a public equity market like NASDAQ or New York Stock Exchange. And the stage I invest in would be called the seed stage. That's typically the first stage of investment. And then they're labeled by letter Series A, B, C, D, so on until a company does a pre-IPO round and then goes public. So those rounds kind of correlate by a dollar value. So a seed round is typically going to be less than $5 million. A Series A round is going to be over $5 million, and then bigger as it goes up. And who really qualifies for it? I mean, any private company can really be a fit. Venture capitalists are typically close who find growth. So the idea when you have a venture capital fund is you're trying to return at least 3 times the money. So if somebody's putting $100,000 in, you want them to get at least $300,000 in profits back. And as a venture capitalist looking at specific investments at the seed stage, like I am, I'm looking for opportunities that I can make 10 times my money. So if I invest $100,000, I'm getting $1 million in profit back. That's the goal at the earliest stage, where you're getting in the ground floor, but you're also taking the most risk. So then as you get to later stage investment opportunities, things become a bit more clear because you're a bit close to IPO or an acquisition.
Okay. Well, that was a good explanation. So the opportunity here is to 3x or even 10x your investment. What sort of time frame are we looking at to be able to get your return back?
Sure. So most venture capital funds range from 7 to 10 years in length. Those investments can take a long time. Again, if you invest it in, WeWork or an Airbnb's most recent round, they're probably about 12 months away from going public. But again, they've already made a name. They're already, relatively safe investment opportunities, and they're going to hit public markets pretty soon. So your liquidity time frame is looking at, it's probably 12 to 18 months. However, if, you and I were to start a business tomorrow and somebody was going to invest in it in a month from now, I mean, their timeline could be, 3 years, 5 years, 10 years. You don't know how long it's going to take to get out there, get clients, be successful, and be ready to go public or sell the business.
So there's a lot of variables. So who do you help? Are you trying to attract investors into your fund, or are you looking for the business to invest in, or a little bit of both? How does that work?
Right. So when you're raising a fund, you're constantly raising capital. I've raised the capital for my fund. So right now I'm looking for companies and to deploy the capital into an opportunity.
Gotcha.
But, most venture capitalists, once they start to become successful in their funds, they'll typically start to raise higher, either, start to go later in stage, so it's higher dollar value, or they'll just, raise larger funds. So that's kind of the goal here is to, be successful early on and then to kind of grow and scale the business.
And then the way it works is you kind of develop a track record where investors say, hey, you did well with this project. Let me invest with you. And then you look for the projects that are going to give them the best return. Is that the way it works?
Exactly. Yeah. The better the track record, typically the easier it is to attract investment.
Interesting. So, what was your path like that got you to where you are now, with your background, business experience, or, what goes into making, someone like you who is, actually launched his own venture fund? That's got to be pretty, time consuming and lots of energy required.
Yeah, so I think two things are important in it. One is you have to have good access to deals. So you have to, get out there and network within the startup community and the early stage industry, building relationships with other funds, and building relationships with the people who are working on different deals, lawyers, accountants, advisory firms, etc. Because they're the ones who, work with the companies at the early stages, and then they can pass those opportunities along to you. And then you have to build a network of capital out for people who are willing to invest in your fund, right? So you have to be able to build those types of relationships and have people trust you to invest their money in different sorts of opportunities.
Interesting. So it still comes down, you're in the people business, right? Because you've got to be able to build those relationships and network and find out about those opportunities. So shifting gears and looking at it from the perspective of a company that is going and they want to go public, they want to raise money. What are some of the biggest challenges you see? And I'm sure you look at a lot of opportunities and maybe only a small percentage of them would really work. When they don't work or when it doesn't make sense from your point of view, what is the obstacle that you find most businesses struggling with?
Sure. It's profitability, right? So a lot of companies at this stage are focused on growth, and it's get them to focus on profits. Because at the end of the day, if you're not profitable, you're going to continue to need to have to tap capital markets. If you look at a company like WeWork, they have billions of dollars in revenue, but they're also losing, $1 billion quarter over quarter because they got so focused on the growth that they never took the time to focus on the profitability. So while the top line revenue number looks great, when you match it up with the rest of their financials, in reality, it's awful because they're spending more money than they're making every single quarter. So it's really getting companies to focus on being profitable. Well, yes, growth is important, but a path to profitability is most important. And that's kind of what we're seeing. I know SoftBank's out there trying to raise a new fund right now, and they're getting some pushback on it because they invested in a lot of these big ideas, big companies like Uber and Lyft and WeWork that aren't profitable. And if you've looked at how Uber and Lyft have done since they hit the public market, they've been down 20% each, respectively. And, WeWork had to call off an IPO and needed some rescue financing really to stay in business. So it's, 2020 is really going to be the year of profitability, I think. And that's going to be a bar that, venture capitalists are going to start setting, is that they're more focused on profits than they are just revenue growth.
Yeah, I think these things happen in cycles. And when you were describing the importance of profitability as opposed to growth, it took me back to the 90s and the dot-com bubble, where people were really excited about these internet businesses, but they weren't making money. They were not profitable, and so that ended up bursting. And because I guess it's the same with personal finance. If you are spending more than you're making month to month, you're going to go into debt, and eventually you're going to run out of money, and you won't be able to survive. And that's the same thing that you're saying these businesses need to be focusing on, not just the growth, but actually profits and making money.
Exactly. And, I don't think we're in a bubble similar to the .com, not in any, sector, but we've seen this happen time and time again, right? We've seen this happen in the cannabis sector, where a lot of these companies raised a ton of money really, really fast, and then a lot of them went bust. because they couldn't figure out a way to get profitable. And we also saw this in the blockchain industry, right? We saw a lot of these companies with ICOs and tokens raise a lot of money, but they weren't making any money. And that's one of the things I emphasize when I talk to founders is the end goal when you're raising capital, the end goal of your business is always get profitable and to generate as much revenue as you can while staying profitable and grow those margins. A lot of people get caught up on raising money, producing money, when the goal is really profitability.
It seems like such a basic lesson. You would think that everyone starting a business would know that profits are the most important thing, but I guess they end up going for the numbers that look good and they forget the basics. Is that what it comes down to?
Yeah, and some of these companies get overfunded, right? And I kind of compare that to being like a consumer taking out a credit card. You know how much you make on a monthly basis, and you should know how much you can out of that you're able to spend while comfortably saving and meeting all your expenses, right? But these big investments to them are similar to a credit card, right? So they just spend, and the revenue doesn't support it. And when you spend investors' money, it's a loss. So if you raise $100 million and spend it with no revenue, you lost $100 million. People don't realize that money is valuable and it's costly too, because you're giving up something for it. Revenue, you're selling a product to generate revenue. You're giving up your equity, the sweat and all the hard work you put in your business in exchange for that capital.
I think that's so important to remember. And, a lot of our listeners, they're probably not in the venture capital market. They are small business owners, and they're just looking to build their business the best way they can. And I think that there's some advantage to not being able to spend other people's money because you bring a greater sense of urgency and importance to actually being careful about spending money and being careful about making sure that you have the margins in place and that you're operating from a solid foundation. And it seems like when companies get big investments of money, that they lose sight of those basics.
I think that's absolutely correct. And that's part of when I'm looking at companies. The most important thing is the people. What's their background? Why are they the right people to invest in? And why are they the right people to execute on their business? So, that's really what you're looking for is the people. That's the first thing I'm looking at. It could be a great idea, but if you were starting, a computer software business, I don't have any background in coding, so I would be a terrible person to run it. So you need the right people. Even if it's a great idea, it's all about the people. I personally tend to think WeWork's a great idea, but it seems like they just had the wrong people. With some of the things you hear about the founder being on a surf trip when they're doing their IPO paperwork, and not to harp too much on them, but it's about the people who can execute and make the business profitable.
Sure, absolutely. Well, that makes a lot of sense. Now, if a company thinks that they may be in the market for some venture capital investors, what are some things they should be doing besides focusing on profitability? But what can they be doing to better position themselves for the possibility of bringing in outside investors?
Sure. Well, first and foremost is looking at the financials, right? I mean, typically people are going to look at a 3-year and a 5-year financial projection. They want to see how much money is the company planning to make and how much are they planning to grow and what do their margins look like over the next couple of years. Because if you're investing, you need the company to be profitable to make returns on your money. So that's first and foremost. And then get their materials ready to present to somebody. So whether it's an executive summary or a pitch deck, something you could send to somebody where they get a good picture of what's the problem your business is solving, what's the solution, what's the target market, how are you going to enter that market, how much that market you're going to capture, and how long is it going to take. And then, your solution and your team, why is it the right solution and why are you the right people to get it done? All of that's important in what an investor is looking for. And then, there's different sorts of ways to reach out, right? Some people reach out directly to the big firms. Some people reach out through, their lawyer or their accountant who might have connections. There's, places like Angel Lists that are good, databases for early stage investors. A lot of people probably find their investors on Google as well. So it's, about putting those things together so you're prepared, having a good pitch, a good message, and then getting in front of the right people to invest.
And just for clarity, this is not the same thing as pitching on Shark Tank, where it seems like they're dealing in almost micro loans compared to the size of investment that you're talking about.
So it could be a small round, right? So Shark Tank's focus is on products for the show. They don't do a lot of technology. So like, for example, a Facebook, when they were raising capital, would never be on a Shark Tank just because it's hard to show the product physically on the show. It's done for show's sake, but I've actually had the opportunity to work with a company that's been on Shark Tank and then went out and raised the seed round. So sometimes those investors on Shark Tank could be part of it, but for all intents and purposes, they're venture capitalists. They're just people who are looking for very small funding rounds, which, are typically done by individuals. And, that's the investors on the show are all individuals. Most of them aren't managing funds. So it's kind of, you're exactly right. It's a sort of micro VC, but the show is very focused on products that can be tangible on the show versus technology that's, tougher to illustrate in a 30-minute episode.
Sure. Well, so then looking at it from your perspective as the owner of a venture fund, how many projects are you looking at? How many opportunities? Is there a limit in your mind, or do you have a certain is there a criteria or a quota? I'm not sure how do you manage something that big?
Yeah, sure. So there's different sorts of funds and strategies, right? Some funds like to invest in one specific industry, such as cannabis or technology, fintech, healthcare technology. I personally think that it's best to diversify, right? I like to pick a leader in each specific sector. So one healthcare technology company, one fintech company, one company I worked with in the beauty technology space, trying to pick a lot of different opportunities across a bunch of different industries. So if, one industry is to bottom out or, valuations get crushed, you have a bunch of other opportunities that, could be successful, to not be so focused on one sector. Where some funds believe that it's better, they think a sector is going to do great over the next 10 years, and they want to, focus their investment on that sector. No one's either really right or wrong, but those are just kind of the two different strategies to pick on what they choose to invest in. And how many opportunities you consider, it totally depends on your size, right? There's some funds that might invest in over 100 deals a year, and there's some funds that might only do one or two, and they're they take a really long time to review and make sure it's the right opportunity from them. So again, that really depends on the size of the fund.
Interesting, and so we've looked at it from the business perspective of the firm that is trying to get financing. I've looked at it from the venture capitalist fund owner, which is you, and now looking at it from the investor. How risky is investing in a venture capital fund as opposed to other options like directly investing in stocks or some other vehicle?
Sure. Well, the first thing to consider is that it's illiquid, right? The only time you're going to get a chance to get your capital back is if the company gets acquired or if the company goes public. Or, they could decide to pay dividends or profit distributions, but that's relatively rare in venture capital. So that's first and foremost. Is your money's pretty tied up. It's not like, Apple or Amazon shares where you could sell them and, have cash in your account within a couple of days. So there's a longer time horizon on venture, and the risk profile all depends on the stage of the deal. Again, if you're, as I mentioned, if you're investing in Airbnb in the last round before their IPO, you risk that the company's stock price might go down lower than you purchased it at when it hits the public market. But, you'd be looking at a 10 or 20% loss versus if you're investing, you're the first money into a company with no revenue, you could lose your whole investment. So it really depends. The risk profile of the deal really depends on the stage of it.
Interesting. Well, this has really been a fascinating look at venture capital from every perspective, and the opportunity, the risk, as well as the reward of investing and investing in businesses. And so this has really been quite an education in just the few minutes that we have spent talking, Kyle, and I really appreciate you being on the show today.
Thank you so much for having me on the show, and looking forward to 2020. And please, if there's anybody who's listening who has questions about venture capital or anything of the sort, don't hesitate to reach out.
You've been listening to Rebelpreneur Radio with Ralph Brogden. Download the show notes and much more at rebelpreneur.com.